Welcome to Global Investment Insights, a weekly podcast brought to you by ADCB Asset Management. My name is Kishore Muktinutalapati, Head of Investment Strategy. With an objective to empower you with investment insights, on this program we discuss various perspectives that are shaping the global investment landscape. Last week, the US Federal Open Market Committee conducted its third scheduled meeting for this year to set the interest rate policy. As we expected, the US Fed raised its policy rate by 25 basis points to a target range of 5 to 5.25%, its highest since 2007, and indicated that rates might now be close to the peak. While the Fed indicated its willingness to be vigilant of risks, the focus firmly remains on returning inflation to its 2% target. In our view, the Fed's data dependence remains the right strategy, so we don't fight the Fed. Looking ahead, we continue to work with the base case scenario that the Fed will go on pause for the remainder of 2023 before starting to normalize its policy. However, amongst alternative scenarios, we see the probability of further rate hikes being higher than the probability of rate cuts over the remainder of the year. In contrast, the current Fed funds future pricing reflects market expectations for 3 consecutive rate cuts of 25 basis points each at FOMC's September, October, and December meetings. On this podcast, we discuss the potential market performances should the Fed indeed go on pause for the remainder of this year, as is our base case. For this, we looked at the history to identify episodes of Fed pausing its interest rate hikes, and we find 10 such since 1974. We looked at how various asset classes performed across each of the episodes, but the points we make here are based on the average of those 10 instances. However, we're mindful that each of these episodes was different, but we still believe that looking at the average experience does provide investors with some roadmap of what to expect this time around. First, looking at the past 10 instances, the more recent episodes of 1997, 2000, 2006, and 2018 saw the Fed pausing interest rate hikes but holding them at that level for at least 6 months. In the instances of more distant history, the Fed had to cut interest rates soon after hitting a peak. We see 2 reasons behind this divergence of Fed behavior more recently versus in distant history. First, lower volatility in growth and inflation during recent decades allowed the central banks to hold on to elevated rates. In the more distant history, volatility was pervasive, so the central banks had to cut interest rates soon after raising them to the peak. The second reason is the level of interest rates, which are low in the recent decades compared to those in the more distant history. For example, the average peak rate in the 6 instances prior to 1997 was 12.3%, while the average of the more recent 4 episodes is just under 5%. The question to be asked is whether the current interest rate trajectory would follow the pre-1997 episodes, or would it be like the more recent instances. We think this interest rate cycle has characteristics of both pre-1997 and post-1997 episodes. Therefore, to accommodate this, we look at the average experience based on all 10 instances. We generally find that global equities perform pretty strongly in 1 month, 3 month, 6 month, and 12-month periods following the Fed pause. We observe the general outperformance of non-US equity markets, but US market performances tend to be the most consistent. Sector-wise, equities of all 11 sectors post gains 1 year after the Fed pause. Turning to fixed income, there too we observed that strong gains followed the Fed pause. EM external bonds and global high yield outperformed strongly in the subsequent 12-month period. Gold prices showed mixed performances across all instances. After having strengthened previously, the broader US dollar stabilized following the last Fed rate hike, but EMFX strengthened against the US dollar. In general, history suggests that risk on follows the Fed pause. While there are similarities, there are also some differences between the current episode and the previous instances when the Fed went on a pause. For instance, weaker outlook reflected in economic and earnings forecasts, still elevated inflation, banking sector stress, the looming debt ceiling in the US, and elevated geopolitical tensions could dial down the enthusiasm this time. Thanks for listening. We hope you found this podcast useful. If you did, please do share this and other episodes with family, friends, and colleagues. For more information, please reach out to your contact at ADCB. You can also log on to our website at www.adcbam.com. My name is Kishore Muktinutalapati, and I'll be back next week with another episode of Global Investment Insights.